Your wealth does not usually disappear during crashes. It disappears in the quiet moments when fear convinces you to step away from growth. The loss rarely feels dramatic at first. Nothing explodes. No account suddenly drops to zero. Instead, something slower happens. Money moves to the sidelines. Portfolios become cash. Plans pause. And time, the most powerful force in investing, continues moving without your capital inside the system. That absence compounds. Most investors do not see this as a mistake. They see it as protection. Markets feel unstable. Headlines suggest danger. Economists debate recessions, bubbles, and financial stress. Moving money away from risk feels rational in the moment. It feels responsible. It feels like discipline. Fear presents itself as caution, but markets operate on a different timeline than emotions, and that difference quietly reshapes financial outcomes. At first, the visible effect seems harmless. An investor sells after volatility appears. The portfolio stops fluctuating. Losses stop immediately. The account feels calm again. There is relief in that stillness. The mind interprets stability as safety, but the market rarely remains still. Prices continue moving without the investor who stepped aside. Some days decline further, other days begin recovering, and eventually the system does what it has done repeatedly across decades. It resumes growth. From the outside, the investor watches the movement continue. This is where the invisible mechanism begins operating. Markets reward time inside them. Compounding builds slowly and then accelerates. Growth stacks on top of previous growth. Returns generate new returns. Over long periods, the majority of wealth accumulation comes from remaining present while the system expands. But fear interrupts presence. When someone leaves the market during uncertainty, they remove themselves from that compounding process. Their capital stops interacting with growth. The financial machine keeps running, but their money is no longer connected to it. The longer they remain outside, the larger the gap becomes. And re-entry rarely happens quickly. That delay forms the behavioral trap. After leaving during a downturn, investors begin waiting for confirmation before returning. They want signs of stability. They want proof that risk has passed. They want headlines that feel reassuring rather than alarming. But confirmation arrives late. By the time markets appear stable again, prices have already moved. The recovery that looked impossible during the panic has already begun. Investors watching from cash notice the rise, but it now feels uncomfortable to re-enter. Buying higher prices after selling lower ones feels like admitting a mistake, so hesitation continues. Days pass, weeks pass, sometimes months pass. Markets move upward while the investor waits for a pullback that may or may not arrive. Each additional gain increases the psychological difficulty of returning. Fear slowly turns into paralysis, and over time, the structure tightens. Because markets concentrate a surprising amount of long-term return into very short windows. A handful of days inside each decade produce a disproportionate share of the gains. Those days almost always appear during periods of extreme uncertainty, often immediately after sharp declines. Which means the moment fear feels strongest is often the moment the market begins recovering. The investor who steps away during panic frequently misses the exact window where recovery accelerates. And because those moments are rare but powerful, missing them permanently reshapes long-term performance. This is where the system quietly locks people out. Not through rules, not through restrictions, through psychology. Fear convinces investors they are avoiding loss, but what they are often avoiding is participation in recovery. They protect themselves from short-term volatility while unknowingly surrendering long-term leverage. And this pattern repeats across cycles. During recessions, people fear economic collapse. During market highs, they fear bubbles. During corrections, they fear deeper losses. During recoveries, they fear buying too late. Fear simply changes its narrative while continuing to produce the same outcome: distance from growth. The uncomfortable realization is that most investors recognize this pattern intellectually. They understand that markets historically trend upward across decades. They know volatility is normal. They know compounding requires time. None of this information is hidden, yet behavior rarely aligns with that knowledge. Because fear does not operate logically. It operates through immediacy. When markets fall quickly, the brain interprets the movement as threat. The same instinct that once helped humans respond to physical danger activates again. Attention narrows. The mind prioritizes survival rather than long-term optimization. In daily life, that instinct protects us. In investing, it interferes. Financial markets are one of the few environments where patience during uncertainty is rewarded. The system does not respond to urgency, it responds to duration. Capital that remains present benefits from the gradual expansion of productivity, innovation, and global economic activity. But fear focuses attention on the present moment. It demands action, and action often means exit. That exit rarely appears dramatic when it happens. It usually begins with a small decision: selling a portion of the portfolio, moving contributions to cash, waiting for clarity before reinvesting. Each step feels temporary, but temporary decisions accumulate. Over the years, the investor who repeatedly pauses participation during uncertainty ends up spending large portions of time outside the market. They participate during stable periods, but step aside whenever volatility rises. Ironically, those volatile periods are when long-term opportunities often form. The investor believes they are protecting wealth. In reality, they are limiting exposure to the moments when compounding resets at lower starting points. And this creates a deeper collision with identity. Most people see themselves as disciplined savers. They work consistently. They contribute to retirement accounts. They follow financial news. They read analysis. They believe they are approaching investing responsibly, which makes it difficult to recognize when fear quietly reshapes their strategy. Because the decision to step aside always feels justified in the moment, economic uncertainty appears logical, valuations appear stretched, geopolitical risks appear unpredictable. Each concern may be valid individually, yet together, they produce a pattern where participation becomes conditional, and compounding dislikes conditions. It prefers continuity. When continuity breaks, the system begins charging a silent cost. That cost rarely appears immediately. Accounts sitting in cash appear stable. There are no losses. Statements look unchanged. But while the balance remains static, the market continues evolving. Companies grow revenue. New technologies expand industries. Productivity increases. The global economy continues compounding even when an individual investor is not. Over long stretches of time, that divergence becomes impossible to ignore. The market level today reflects decades of uninterrupted participation from millions of investors who remained inside the system through crises, wars, inflation shocks, and recessions. Their wealth did not grow because they predicted events accurately. It grew because they stayed present. Those who stepped away repeatedly often discover something unsettling years later. The market they once considered expensive or dangerous has moved far beyond the level where they exited. Re-entering now feels even more difficult. Fear becomes permanent distance. And distance from the system means distance from its compounding power. The real cost of fear is rarely visible during the moment it influences behavior. It appears slowly across decades as missing growth, smaller portfolios, and financial goals that drift further away. Not because the investor lacked intelligence, but because they allowed emotion to interrupt the one process that rewards uninterrupted time. And once that interruption happens repeatedly, the most valuable resource in investing begins to erode. Not money. Time inside the system where money multiplies. And once time passes outside that system, something quietly becomes impossible to recover. Because the market continues compounding whether fear participates in it or not. And the longer someone watches from the sidelines, the harder it becomes to return to a system that never stopped moving forward. For more long-form thinking about investing, incentives, and financial systems, subscribe to Finance Simplified.